All right, so here we are, the third and final part of this three-part series on the most important things for qualifying for a mortgage, right? Part one was credit. Part two was income, GDS, TDS. Now part three is going to be, drum roll, down payment. Yes, it is, down payment. The part that a lot of people, it's a misconception. A lot of people don't understand it entirely. There's a lot of rules around it. 5%, 20%, 15%. What is all this stuff? Insurance. Down payment is super important because you got to have some skin in the game to some extent in order for lenders to be like, yeah, cool, no problem. I'm going to lend you 80% of this property, 85, 90% to buy this home, but you got to have some skin in the game. You got to have some down payment. So what does down payment look like? How can you use it? Where can it come from? And what percentage do you need? Let's talk about that. All right, so in a perfect world, obviously the more that you can put down, the less your monthly mortgage payment's going to be. And of course, the lenders love that kind of stuff. You don't need mortgage insurance if you put, 20% down or more. You don't need to go out and pay for extra insurance that covers the lender. Now, at the same time, the price of homes, it can be difficult. A lot of folks can't save as much as 20% down on like $1 million home, right? So, or in some cases even more. So the reality is that you can put less than 20% down, but if you do, you got to pay for some mortgage insurance, and that gets built into your mortgage payment. So 20% down is optimal, but it's okay. You can still buy a home with less than 20% down. So yes, less than 20% down does open the door for a lot of first-time home buyers, and it also opens the door for a lot of folks who want to get into a home that they otherwise wouldn't be able to get into. Now, what does that mean for others? It affects other areas of the mortgage, the type of lending that you can get, maybe how long you can amortize that loan out for, but the reality is that you do have options, so you can put less than 20% down. Big one, where does the money come from? It's so important that we got to be able to track the money. So it can't just appear out of a shoebox, the day before. You got to be able to have usually at least 90 days of bank statement history showing the money that's in there. Or if it's not and it comes from somewhere else, we got to be able to trace that and show where it comes from. So listen, down payment funds are important. You can't be secured funds that you can't access them quickly. So it's got to be like TFSA, cash, checking, whatever it might be, savings. If you're going to be redeeming money from an RSP, a LIRA, whatever it is, which is fine. There's ways you can do that if you're a first-time home buyer or what have you, but we got to be able to plan for that in advance. So always come as early as possible. If you're looking for a home, you're thinking about buying, so we can talk about these things early. Another thing is a gift. Yes, it can be a gift. A gift is fine. It can come from a family member, relative, but it will need a gift letter basically that says that this is a gift and this person doesn't need to pay me back. So down payment is super important. The third part of this three-part series on the most important things to qualify for a mortgage. All right, so that's it. Now you know the three most important things to qualify for a mortgage are credit, income, and down payment funds. Any questions you have, I'm here for you. Hit me up anytime. I'd be happy to help. Now you know.